How we doing, traders? Welcome to Money Mitch. We got a great show for you today. We're going to talk about did we get that January effect in some of the growth stocks. We're going to get into a great interview with Guy Davis. Just stay tuned, guys. Welcome to Money Mitch.
It's time for Money Making Mitch. When investors need a story, we're going to the moon. Welcome to Money Mitch, where story is everything. I'm here to find you the next opportunity. It's all about the green hands. Now we all know the bull market is here to stay. Money Mitch.
How we doing, traders? Welcome to it. I hope you guys had a great New Year's break and were able to spend some time with the family. Avoided the COVID action that was going on out there. Let's go ahead and let's take a look, like we always do, at the overall market and see what we saw today. So let's go ahead. Let's take a look at the hourly charts. You guys know how I like my hourly charts. Let's take a look at the SPY, see what we saw here. And kind of the same thing that I was expecting in the SPY happened today. I was looking for a kind of a washout of the retail traders, everyone kind of leaning one way towards the bell, thinking that we were going to get that January effect, everyone pushing towards the buy. And what happens? A retrace to these hourly supports is common what I see, especially when everyone's kind of leaning towards that one side. Smart money looking at a bigger time frame, looking for that support entry. Then you got that nice big washout in the SPY right out the gates here. You got a little pop up and then it washed down right to that support around 475. The big thing there, I said, can it hold that hourly support of 475? Give us a close above that. We went towards a low of 473 and actually closed the candle right there at 474.93. The next candle actually opened up at 474.94, immediately claiming back up towards that 475, showing us that that support was getting bought. And you could see this on a lot of stocks. Let's take a look at some of the stocks that we were trading today, or we're looking for some big moves. You can even take a look at something like Lucid. Let's take a look at a Lucid, which took a big rip on up today. If you can see here on the hourly chart, you can see how we were going sideways right out the gates. We actually went down, we went up towards that resistance, came back down towards that support of that 38, then we rocketed back on up. That's why it's so important to know where your bigger time frame supports are and be looking for those moves. I went after some of these kind of plays, trying to get after some of these January effect plays. We were looking at the Qs to see if the Qs were going to recover 400. It kind of did the same similar move, hourly support going back down, trying to take out this low, and it went right to it. And then what does it do? It reclaimed that 397.37 here, and then went right back up there above 400, which is what we wanted to see on the close. Let's take a look at some of these names that I was looking at. I actually ended up getting into ChargePoint for a swing trade here, guys. So I'm looking at ChargePoint to continue moving on up. This is a specialty retail stock, charging station infrastructure. One of the things that I was looking for this was the same kind of move. It pushed down towards the low, going down there towards that hourly and pulling right back on up. I got into this one today towards 1940. Is going to look for this one to continue pushing on up. I said as long as it closed above 1950 today, I would be feeling nice and bullish about the swing trade. We'll see what happens, and continues moving in ChargePoint. All right, let's go ahead and catch up with the chat. How we doing out there? Eagle, Jim, Super SPAC Man, Aaron Sachs, Easy. What's going on out there? How you guys doing? Did you guys get a good trade in this kind of January effect? Let's go ahead and take a look at some of the other ones. Tesla really kind of leading the auto manufacturers today. We actually took a live day trade on this one on live trading, and it was a solid win. We saw this one trying to break down through the VWAP 3 times. When it recovered there at that 1150 price point, we ended up getting in right around this price point. We got it in here towards 115336. Ended up selling all the way up there towards 1170. So 1170s at the high of the day. We ended up getting the top shares out. Not a bad trade there on Tesla. Let's take a look at some of these trades that we're going to take a look at. I'm going to start rolling through some of the names that I'm looking at for swing trades on a longer term basis, kind of these growth stocks that could come back. One that had a decent day was DM. I'll keep an eye out on that one. Triple D is another one to look at. That's 3D system. I really do think you're going to see 3D kind of pick up into this year. We'll see if these can kind of start making moves. With ChargePoint, I'd also take a look at Volta, VLTA. We'll see if that one can make a move. And for that being mentioned, EVgo. Those fall under those charging station stocks. Let's take a look at my favorite lithium play right now, PLL. I'm looking for this one to have a great day, and we had an awesome day today, pushing on up here. Let's take a look here. You can see in the pre-market, it was pushing on up really high. We'll look for a breakout through 55 on this one. Reason why I'm looking for these lithium plays is that this is just kind of more inflation into a solid asset. We'll see how PLL performs. All right, let's keep going. Some other plays that we can take a look at. Department stores. Macy's was a Santa Claus rally stock that we gave last week on Monday, looking for a little push in Macy's. We got a nice little push today. It actually went towards a high of 28.52, probably about like a 10 or 11% stock from that Monday. Not a bad play there in Macy's. Also, DDS was the other stock that we gave. We'll see if this one can get back above 260, and that's Dillard's. All right, so just to kind of mention one more kind of area that I've been looking at is pharmaceutical stocks. So let's take a look at some of these pharmaceutical stocks. WBA is one that I'm looking at, Walgreens Boots Alliance. We've talked about this one the moment we started getting the Omicron variant. One of the things that's important was I was looking to see if we were going to get more testing. I think that's one of the reasons why you're seeing Walgreens react the way you're seeing now. You could also take into account Rite Aid. So that's RAD. This one having a good chart right now on the daily. We'll see if it can take out 1523, which is a big resistance. But today, breaking through that 15, which was also an important daily price point. Let's take a look. Also, CVS has really been kind of the leader. I wouldn't want to see that one turn away. And you can see here from the daily chart on CVS how strong it's been as of late. We'll see if it gets through 105 and continues making moves on up. Like always, we like to take a look here at our sectors. What was strong today was definitely energy. So some of those plays you can definitely take a look at. We'll take a look to see if this REI can continue making moves. Kind of some of these cheaper ones when we're making moves today, RIG. But you can also take a look at MRO, Marathon, trying to get on up through the 17. We'll see how that one moves. CVX. Chevron Corp, we'll see if that one can hold 119. I did see that one break through 119 today, and it's holding that. The big thing is, can they hold it tomorrow and continue making moves? If you want to do kind of more of a day trade in these energy trades, I usually look at the oil, kind of the bull here, 2X gush trade. Nice trade on up there today from 90 to 95. We'll see if these can continue making moves. Communication services doing decent today. Not a bad day for those. Consumers, cyclicals, auto manufacturing. We talked about how strong that was. We're going to take a look at luxury goods. That was a lead move by SIG, but I wouldn't trust this one too much. I mean, luxury goods. I mean, inflation can help kind of the jewelry right now get a higher price, but it's not on my top radar right now. Falso also making moves on up. We'll see if that can continue. Broadcasting doing well today. Some of these stocks like Discovery and Viacom having not a bad day. Fox also not a bad day. We'll see if these can kind of get off the ground. They definitely have been hurt for a long time. DSCA, Discovery, getting off that ground today. 25 for that one. We'll see if that one can hold. All right, there. How we doing out there in the chat, guys? In a second, we're going to be getting into an interview here. We're going to go ahead and interview Guy Davis, the CFA portfolio manager and managing director of GCI Investors. They also have an ETF, GCIG. So definitely check that one out, guys. We'll get into that in a second. So looking forward to that. But now let's go ahead and touch some of the stocks that you guys are mentioning in the chat. Don't want to miss out on the stocks that you guys mentioned. So DIS, definitely a great trade kind of today. This one has been mentioned, by another network. I'm not going to get too much into it. I know they've been talking about this one on that network often. and looking for a kind of a longer term trade. And really, I think it all based off this 28 move. If you use the hourly, you kind of see it. You've been trying to get above that resistance and hold. You got above it. You held it today on those pullbacks at 155.80. That's a good look now. We'll see if Disney can start coming back on up and getting back towards this gap, which starts around like 165 up there towards the 178 area. We'll see if Disney can start pushing back and maybe take out that daily shadow. I definitely do like Disney at the end of the day. I mean, this is a company that you've seen kind of really retrace, get oversold. We'll see if it kind of starts bouncing back into January. All right. Also in lots swing trade. Oh, that's a crazy one. Easy, Mike. I'll definitely leave that one to you right now. But let's keep going. SoFi and Hood are your picks for January effects as Eagle. SoFi is an interesting chart. Let's go ahead and take a look at that, and then we'll get into our interview. So SoFi retracing actually today a little bit, which is kind of a little bit concerning to me. I wanted to see these stocks kind of rip on up today, kind of really get that strong move. I wouldn't want to see it really start kind of coming back and trying to take out kind of the 15. 15 is that really hard support right now that we want to see hold. If that comes through 15, I think you might be able to take out the monthly lows. That's 13.59. Then we can be back at $10 really quickly. Hopefully that's not the case here in SoFi. But like always, guys, you got to be careful for those moves. And take a look at the deeper time frame. You're still pulling back. Let's see if the daily can get on out through that 17. That's really when I would see the daily start getting into kind of more a bullish look. All right. Looks like Jim has been adding in Ford. Ford has not been a bad one. We'll definitely kind of see if Ford can continue making moves. It was one of my favorite patterns, guys, because you guys got all those three resistance. You got to push on through. Then it held that pullback, that throwback there at 2050. And you can see today, nice move on up there. Could possibly get towards 22 tomorrow. Nice move in Ford today. All right, guys, that's going to do it for the stocks going into it. Now let's go ahead and get into our interview. When we return, we're going to go ahead and get into an interview with Guy Davis. This is the portfolio manager and managing director of GCI Investors. What I like about this is that we're going to get into a little bit more about the fundamentals. You know how I like to talk about on Money Mitch, we focus on three variables. We don't only focus on, let's say, technicals, a story. We also focus on the fundamentals. Today, we're going to learn a little bit more about why companies focus on fundamentals. Let's get right into that. And when we return, we'll get into it with Guy.
I tell all my CEOs, this is a very, very, very important platform. And look, all the other platforms are important too, but you're up there now. You're way up there.
Best investments you can do in your future is actually go and educate yourself on credible sites and credible resources like Benzinga. I think you guys have been killing it.
The comment section on this show is remarkable. Like the quality of the combo, and just big shout out to you and your community.
So I love about you guys, you just had all your callers in right then. And it's all about the community here at Benzinga.
All right, let's go ahead. Let's bring on Guy Davis. How we doing? Welcome to the show.
Hi, Mitch. Thanks for having me.
Hey, I appreciate you coming on. One of the things is we like to talk about different catalysts. I know that GCI is more on the fundamentals. We'll get deep inside of that right now, but a pleasure to have you on the show today.
Thank you, sir. I appreciate it. Yeah, certainly. We're very much a fundamentals focused house, so I'm very happy to kind of walk through however be most useful for you and your guests.
Definitely. Let's go ahead. Let's dive in. First, let's learn a little bit more about your background and what brought you journey to GCI Investors.
Sure. So my background originally was in London. I used to run a couple of mutual funds out of London, and really my focus has always been on fundamental bottom-up stock analysis. I came across the firm at GCI. Actually, GCI has been around for more than 20 years. I've been heading up the firm and running it for the last 5 years. And really the key thing for me was trying to find somewhere that the investment philosophy matched with my own. We have a very kind of specific way of investing here. It's a little bit different to, I would say, the way most Wall Street or investment firms would approach investing. And so having the opportunity to come out here and take over the firm and manage things in a very specific way was hugely attractive to me personally. So we've been fortunate. We've built a very successful track record over a reasonably long period of time now. And as you mentioned, we recently launched our first ETF, GCIG. That's launched and now trading on New York Stock Exchange. And as a firm, I would say, we are very much a very focused firm in that we run one strategy, one single portfolio. I've always been a big believer in we're far better off doing one thing and doing that one thing well than trying to do lots of different things. So one single portfolio is all we have, and that's likely all we're going to have for a considerable period of time.
Yeah, they always talk about it in trader, right? There's a lot of traders that try to, do every trick in the book, but really, I mean, a lot of times we just want to be good at that one trick. One trick pony sometimes can really bring the returns. Let's go ahead. Let's talk a little bit more about GCI investors and, of course, the ETF, the GCIG. What should we know about it, and why was the ETF created?
Sure. Well, certainly, we called our ETF the Genuine Investors ETF. And really, we refer to our process as genuine investment. And what that really means at its heart is that we make a very significant distinction between a business and a stock. And the way we look at it is the underlying value of any business is reasonably fixed for the majority of the period of time. If you and I were looking to, let's take a company like UPS. If you and I had unlimited capital and we were going to go and buy UPS as a company, we could establish a number that we'd be willing to pay for it if we were going to buy it and run it privately. That number isn't going to change much day to day. It's going to be broadly the same in a month's time. It's going to probably be reasonably the same in a quarter's time. So kind of the underlying intrinsic value of a business doesn't change much over a reasonably kind of medium-term period. In contrast, stock prices change multiple times a day. They're changing every single minute. And the reason is, while the intrinsic business value is really driven by what we could extract from the business in terms of owners, in terms of long-term cash flows, the stock price is driven by that business value, but also an awful number of other variables. So the stock price is driven by news flow, it's driven by sentiment, it's driven by emotions, it's driven by the prices of other stocks. Now, all of these additional variables that will drive the stock price, they're all very short-term in nature and also typically don't actually impact the underlying business value. If we just carry on with the kind of UPS example, the UPS share price today will be affected by movements in the FedEx share price. Now, the actual value of UPS as an entity and UPS as a company is completely unaffected by the share price of FedEx. If we're going to buy UPS and run it privately, it doesn't really matter if FedEx stock goes up or down. It doesn't make one difference to us. So we make a very significant distinction between the two. And from our approach, I don't think myself or any of my team have any ability to forecast where stock price is going to go in a short period of time. What we can forecast with a reasonable degree of accuracy is underlying kind of business intrinsic value and where the earnings of a company might go over a 3 and a 5 year period. So we spend our time focusing on the underlying company, trying to forecast the underlying earnings of a business. And really for us, the stock market exists simply as a means to provide us opportunity to access these companies. We don't really look at the market as providing us with information about the value of a business. It's just providing us an opportunity to transact. So it's a little bit of a different approach. It's almost kind of erring on a slight private equity approach, but using the public markets to get us into these companies.
Yeah, one of the things you said it best, you're focusing on the company's value, and that's what matters most here. How does GCI source ideas?
Yeah, great question. So I'm a big believer in trying to have as few things to forecast as possible and as few things to go wrong as possible. Because really in investing, everything we're doing is involving some estimate of the future, some forecast, and we're taking some element of risk. Now, the fewer variables that we need to forecast, the fewer things there is for me to get wrong. So we love companies where there are kind of very significant, inexorable long-term trends. So for example, 2 of the largest positions in the portfolio are cell towers, CCI and AMT. Now, these companies they're direct beneficiaries of more and more of us consuming mobile data every single year. Now, we can't sit here between us and construct a scenario where we consume less mobile data as a globe next year than we did this year. It doesn't matter what happens with politics, doesn't matter what happens with COVID, Omicron, we're all going to use more mobile data. We've got, internet video, we've got smartphone penetration, we've got Internet of Things, connected vehicles, et cetera, et cetera. Now, that as a kind of a long-term trend is a wonderful place to be, because it immediately enables me to be comfortable that these companies have a growing pie from which to kind of obtain earnings. Mm-hmm. So we love anything like that where there's a very clear ability for us to forecast what's going to happen into the future. I would say the flip side of that is there's an awful lot of sectors and industries that we as a firm don't go anywhere near because we don't feel that we have any ability to forecast returns. I would call out energy as an example. We hold no energy companies and likely won't in the foreseeable future, just on the simple reason that I don't think we have any ability to forecast commodity prices. And realistically, however many things are going on, when you really boil down to it, your returns are driven by the underlying commodities that you're trading in as an energy company. And if we can't forecast the biggest driver of returns, then in the way we approach it, we really have no business allocating capital there. So we run a very concentrated portfolio, 20 to 25 stocks, and it looks very different to the majority of indices because there's an awful lot of sectors that you just won't see featured in our portfolio. We very much take the view that just because something's in an index doesn't mean we need to own it.
Yeah, I like that. One of the things that we do here on Money Mitch is definitely try to pay attention to sectors. And there's definitely different sectors that are easier to kind of look for a longer term gain than certain others, right? I mean, if we were focused on consumer defensives, I mean, yes, some of these companies can look good on valuation, but the growth sometimes just isn't as high also. So one of the things that I wanted to talk about was when you guys are looking at business value, what are some of the key things that stand out? Are you guys, I know you guys focus on discount cash flow models, but what are some of the key things that you guys are looking at? You guys focus on revenue? You guys focus on operating margins? What are some of the key things?
Sure. So for us, we really try and get a very deep understanding of the underlying company. So again, outside of the stock. And really to do that, yes, we'll go through the GAAP accounts and we'll go through the 10Ks and the 10Qs and we'll read the earnings transcripts. But all of that, I would say, only gives you a part of the picture of any company. Again, in the same way that if you and I were looking at a business and we were going to go and try and buy it, we would never do that just based on a 10K and a 10Q. We would want to understand the industry deeply. We'd want to understand the competitive dynamics. We'd want to understand the competitors, the product fit. We'd want to understand what regulations going on in the industry. We'd want to talk to customers. We'd want to talk to suppliers. We'd want to talk to the management teams. We'd want to talk to employees. And all of these areas, I think realistically as well as an industry, an awful lot of these areas get left because they are subjective. They're qualitative. It's very difficult to get a black or white answer. As an industry, I think finance generally, everybody loves the numbers and they love the, stock A is better than stock B. And people can do that with ratios and they can carve things up from accounts and they can do quant screens and they can rank stocks. In reality, to really understand a business, so much of that work is subjective. So I would say for us, it's going to take us at least 2 or 3 months before we would get comfortable with a company to even begin to approach the process of valuing a business. Because really, for us to be able to conduct a useful DCF, we need to understand the business extremely well. I think DCFs are incredibly powerful tools, but they are a great example of kind of garbage in, garbage out. And if you don't know the company well and your forecasts of earnings are perhaps not so reliable, they end up being a not so useful tool. I also think it's always worth bearing in mind that any business valuation is subjective. Valuation in itself is inherently kind of as much art as it is science. We could sit down with exactly the same data and come up with different answers. And so we never want to be completely tied arbitrarily to individual price points. I often think it's better to think of kind of business value more in terms of a range than a specific price target.
Love it. Really. I mean, that's I don't think you honestly could give more to the retail investors out there than kind of that answer within itself. Whenever we're looking at valuations, it's never anything exact. I mean, today Apple broke that 3 trillion mark, right? I mean, we don't know if they're really valued at 3 trillion right now. Let's go ahead. Let's look at one last thing. What's the general waiting period for these positions? What's the time horizon looking like?
Yeah, we typically invest with a reasonably long time horizon. I would say kind of 3 years and longer, on the basis that, I mentioned some of those kind of shorter term factors that I think can move stock prices in the short term. Honestly, I don't think we have any ability to predict those. Over the longer term, I'm sure you've seen the data that once you go past kind of 3 years, 5 years, the biggest driver of returns tends to be the earnings of a company. Because really, stock prices can get swung around on news flow and what other stocks are doing in the short term. But over the long term, if a company's grinding out 10, 15% earnings growth every year, it's going to get reflected in the share price eventually. And on the flip side, it's the same on the way down. So typically, we may need some time for those kind of things to play out. We don't spend too much time focusing on short-term performance or short-term relative performance. Everything we're really doing is kind of with a 3-year view.
Yeah, excellent. Now, the last thing I'd have to ask about the ETF, what would cause an exit of a position?
Yeah, good question. So we utilize IRRs, internal rate of returns, for all the positions that we hold. And the way we do that is, we talked about the DCFs. We spend our time analyzing a business. We establish what we think is the underlying intrinsic value for a company. Based on where it's trading in the market, we can calculate our expected return between the two. So for every position in the portfolio, we've got an expected return. We use those a great deal in managing the portfolio. And what basically happens is, if stock prices run extremely hard and the underlying fundamentals of the business haven't changed, we may get in a situation where our expected returns, they're going to be dropping over time. And if we're getting to a situation where our expected returns are, let's say they're falling into single digits, it's not becoming an attractive use of capital, that's a great trigger for us to think about moving on. I would say the other main reason is if something fundamentally changes at the business, if there's a change to the competitive dynamics, if something's changing in the industry and our estimate of future earnings is going to be severely impacted, that's going to be a real driver for us. So for us, really, the vast majority of these decisions are coming about based on what's going on at the underlying company. That's really going to be the driver for us that would cause us to move on and sell something.
Excellent. So there you guys have it. That's definitely a great outlook on the GCIG, the Genuine Investors ETF. Last question I have for you is more kind of an opinionated question. Just wanted to ask you, how do you feel about the way that the stock market's trading right now in valuation? We have certain tech stocks that are trading extremely past their earnings. How do you see it? Overvalued, undervalued out there? Overall kind of look, how do you see it?
I think the overall, I think, is extremely difficult in a sense that you see all these charts all the time, and people put charts in magazines and newspapers, and they say S&P multiples all-time highs. And I think one of the things people miss an awful lot is that the S&P today is very different than it was 5 years ago, and it's very different than it was 5 years before that. So I often think the kind of headline market multiples comparisons don't make a huge amount of sense, because it's kind of, you're not comparing like with like. Now, I do think there are pockets of extreme exuberance and overvaluations within certain sectors. And I think some of the things that have gone on in the last 12, 18 months with some of these kind of meme stocks has been extraordinary, genuinely fascinating, and a little bit terrifying in some places. And I think we're in a slightly odd situation where some companies that arguably, you take something like a GameStop or an AMC, arguably these companies wouldn't exist as going concerns in a normal environment, and they've been propped up through the kind of the meme investing, as it were. That's quite an interesting phenomenon generally, because it's almost changing the corporate landscape. I do think there are an awful lot of pockets of the market though where valuation is not extreme. We own GFL, waste management company, trading at very attractive valuation. We recently took a position in Tyler, software company, again, inexpensive. We mentioned UPS briefly earlier, kind of traditional value stock. I think there's an awful lot of space in names like that. So there are certainly areas where I think people have got too carried away. But I think if people are focusing on individual companies, there's places that people can find good value today.
Yeah, definitely. I appreciate you joining us here. That's Guy Davis, guys, CFA, portfolio manager and managing director at GCI Investors. I appreciate you joining us, and I definitely have to agree. You have to just look out there, right? I mean, there's always going to be some kind of stocks that are overvalued, some stocks that are undervalued. So if you can go ahead and do the research, look into the valuations, or go ahead and look at GCI Investors and see what they're going ahead and looking at.
Thanks, Mitch. Appreciate you having me.
Appreciate it. All right, there you guys have it. Another exclusive interview right here on Money Mitch. I hope you guys enjoyed these interviews. We're going to keep going to more money managers, kind of the people behind the money, what you want to see, guys. So if you guys have someone you guys want to reach out to, definitely let me know in the comments below. I'm going to keep going and reaching out, looking for more traders, and kind of, if we can bring investment strategists, we're going to definitely do it right here on Money Mitch. And that's all to kind of benefit you guys, learn a little bit more about this. So there you guys had it. This was GCIG. I definitely tell you guys to take a look. You know, one of the things that we always mention is the fundamentals. The fundamentals definitely matter. Now, I like to go ahead and use 3 variables, not just only the fundamentals. I like to use technicals and story, but that's because I'm a swing trader. Find what's best for you guys out there and keep working at it. Until then, guys, hit the thumbs up. I'll be back tomorrow. I'll see you guys on pre-market prep. Let's keep working at our trading skills. We're going to keep seeing if some of these can make 2-day moves. So remember, we talked about some of those. I'm in ChargePoint. I also took Square, guys, on the long-term swing trade. We'll see what happens on these, and I'll see you next time on Money Mitch. Until then, guys, hit the like and let's keep it going, guys. I did see you guys talking about lithium in the chat. Let's talk a little bit more about lithium tomorrow. What I'm going to do is I'm going to break down the top stocks in the lithium game, and we can see which one we like as our favorite. So come back tomorrow, guys. I'll see you guys next time.
It's time for Money Making Mitch. When investors need a story, we're going to the moon. Welcome to Money Mitch, where story is everything. I'm here to find you the next opportunity. It's all about the green hands. Now, we all know the bull market is here